So this is Forex 102. 102. And here we are continuing with the fourth element, which we clearly said was the knowledge. Or the skill. And in this here, we clearly stated that the fourth element, which is the knowledge or the skill, and the skill we are going to be exploring is what we call the price difference. So if you have not watched the first video, it is important for you to go back and then watch it so that you can follow with us properly. So now, what do I mean by price difference and how do we trade price difference? So price difference is definitely not SMC, smart money concepts, but then it also uses some parts of smart money concept. It also uses purely price action. And then here we involve the use of highs and lows that market has created as it moves. So in simple terms, when we talk about price difference, we just want to get the difference. So price difference, I'm going to abbreviate it with a PD, is therefore the difference between highs and lows that the market creates. So when the market moves, the market creates highs and then lows. So lows are created and also highs are created. So the difference between them is what we call price difference, and that is where we build our trading on. But you need to understand how the lows come about. So the lows come in form of a trend. And that trend has to either be an uptrend, has to be an uptrend, or it has to be a downtrend. Now, the reason why we have those ones there is because the market is not linear. By linear, I mean the market doesn't move like this. So the market moves in almost what we would call waves. So you would have, instead of the market going up, in a linear form, it would go like that in almost a wave form. And in case of market coming down like it would, it instead comes down in form of waves. In form of waves like that. But now our strategy is to be able to identify the differences between the highs and then the lows as the market moves in the waves. And there is no better way for you to be able to identify these highs and then these lows without understanding candles in trend. So the most important thing in this thing, the next one is for us to understand is the candle, the candle pressures and their formation. So you can trade using either candles, you can use candles or lines, but most of the traders prefer the use of candles. So in using candles, this is where you are introduced to the whole concept of the Japanese candlesticks. So there's a whole book for it that you can search. But the most important thing I would like to share here is the candle pressure. So the pressure in a candle determines whether that candle is going to be pushing price up or down. So let's have a candle, which is a basic candle, which is like this. So let's say this is our basic candle. So the moment you have a candle which is like that, what you need to understand here is that this can either be a bullish or a bearish candle. This is a candle, one, and then there's also, we can have another candle of this size. And then we can have a candle which can just be in form of this. So if you look at this in terms of pressure, definitely this one has higher pressure. Pressure is high. This one has a low pressure, and this one has neither low nor high pressure. So this is indecisive. So the moment you begin to see a series of these, price can actually move violently to the upside or to the downside. And the moment you see this, you know the price is reducing. So we will go in depth about candles, but it is important to introduce it this way at first. So let's see you in the next series.